Welcome back, everyone. Today on the Joseph Carlson Show. Apple is one of my largest holdings in my portfolio. It currently sits at a value right around $50,000, with around $20,000 of that being gains. This is a company that I've been investing in for 5 years. I've studied Apple as a business in depth, and it's been one of my biggest winners in my portfolio. Now, Apple stock has recently done really well. This year, it's up 36% year to date. There's all these articles saying that Apple's one of the stocks driving the market this year. 36% gains year to date, and Apple's approaching all-time highs at 170. Now, the company has an earnings report coming up May 4th, which is this Thursday. And I have some concerns about this earnings report. And I'm not the only one that's a little concerned about this earnings report. We also have the technical analysis guys like Carter Worth also expressing concerns, and I want to look at that as well. Now, we have some other big news. JP Morgan has seized control over First Republic Bank after the bank lost all of its deposits and went under. We're going to be looking at this news. And we have Charlie Munger joining the voices of others that are saying they are worried about the commercial property loans. And then finally, in some other big news, we have a massive update to Qualtrim. This is the stock analysis tool and portfolio tracker that I've been developing specifically for my audience for the past 3 years. And this is one of the most significant updates we've ever had to the platform. So I'll show you some of the new look and the new features of this new update. So we have a lot of news to get to in this episode. Before we jump into the Apple specific news, I want to mention a quick word about a project that I've been working on for the past 3 years. This is something that I own completely. It's my project that I've created since starting this YouTube channel, and it is Qualtrim. Qualtrim is a stock analysis tool and a portfolio tracker. Now, I want to give you a little bit of a behind the scenes of how this has evolved over time, because it's been an interesting journey. When I started YouTube, I would track everything using spreadsheets, mostly on Google Drive. I'd track my dividend growth and my year-over-year dividend growth. A lot of other people wanted to use those same spreadsheets. They wanted me to copy them, but then I noticed every single time I did an update, I couldn't push the update out to them. So it was very difficult. In fact, it was impossible to keep a spreadsheet updated from me to thousands and thousands of viewers. That's where I decided to create a website where I could push unified updates and I could build a platform that's much easier to manage. And that website is Qualtrim. This is a tailor-made website for the audience here, something that I've worked on specifically with the feedback of thousands of viewers, hundreds and hundreds of comments, hundreds of people giving me continual feedback on it. And with a background in development, since I've worked in development for 10 years, I have a unique advantage as a content creator to be able to leverage tools and assets and different resources to help me build this as quickly as possible and done as well as possible. Now, Qualtrim really has taken off. To say the least, this application is growing rapidly. Every single year we add on more users, and currently we have in excess of 3,000 users. In fact, we're climbing closer and closer to 4,000 users. There's a lot of investors using this every single day as their primary research tool for stocks. So first of all, sincerely thank you to everybody that's tried this out, that uses it and enjoys it. I hope that you enjoy it, and it's only going to get better and better. The latest update we did, I think, is one more step in how much this is going to improve over time. We revamped the entire website. We built it on an entirely new platform with a new framework, with a new front-end CSS library. Everything is rebuilt from the ground up, and it's much faster and much smoother to use. A lot of the look is the same. It looks very similar to old Qualtrim, and we kept it that way intentionally because old Qualtrim looked very nice, but there are some subtle changes. For example, when you go to the free cash flow chart here, we have the normal free cash flow, then we have the free cash flow with stock-based compensation. So you can see them side by side. Then we have what I call adjusted free cash flow, where it nets out the two. We can see the normal free cash flow minus the stock-based compensation. So you see how much money you really have at the end of the day with a company. This is something significant that most tools like this don't show you. And we do the same thing for free cash flow per share. We adjust out the stock-based compensation with the adjusted free cash flow per share. This is just one example of the many upgrades that we've done with this new version. And throughout the website, there's more and more of these type of upgrades. We've even added in entirely new charts like the employee count over time. And the new watch list is incredible. It shows you all the stocks you're following on a list off to the left with their current price change. It shows you their upcoming earnings of every company in your watch list organized by date with their estimated earnings per share and revenue for this quarter. Then we have an advanced dip finder that you can see which companies are in a dip over the past 30 days, or which companies are in a dip over the past year. You can now filter by different time ranges to buy the dip in your portfolio, and this works for ETFs as well. And it also shows you a newsfeed specifically catered to your watch list. The new portfolio section is also built on a better framework to help you manage your portfolio and tracking your allocation. We have the current value, your estimated annual income. This is how much I'm going to earn in dividends over the next year, the number of holdings. Then we have the value over time. We have the asset allocation in pie chart format. So I can see exactly how big each company is by percentage. I know that S&P Global makes up currently 13.2% of my portfolio. We have the gain and loss for each holding by percentage terms. We have my monthly dividend income over time. Then we have a new chart here, the portfolio value by sector. This is a spider chart that shows you where your exposure is, and then a price to earnings chart for each holding. And we're building out more and more tools continually. We have the upcoming dividends on the left here, the recent dividends on the right, and then we have a holdings tab here that shows you all of your holdings with your gain and loss. And then there's just a lot of other little cool things we've done with this version. For example, on the top navigation bar, there's the Dow Jones, the S&P 500, and the NASDAQ. And you saw it flash there for a second. That's it updating the prices. Every single number, every single price on every page updates automatically every minute without page refresh. So whether it's the price of the company or whether it's the indices, all of it's getting fresh data every single minute without page refresh. So you know when you're browsing Qualtrim, the entire website is up to date the entire time. And then finally, the last thing that I'll mention is I've had some feedback. A lot of people have said, Joseph, I've loved the website. I think it's great, but I like browsing in the dark. I'm down in my office or I'm browsing late at night, and I like browsing at night. And that is why we created a beautiful dark mode. And I do think it looks gorgeous. Every single view of every part of the website has dark mode. So whether you're browsing the charts on Insights, you're looking at the company profile, or you're going over your watch list, all of it has this gorgeous dark mode. So this has been an incredibly fun project to work on, and I'm very grateful to the 3,000 plus of you that are using this every single day. And if you haven't tried it out yet, I would recommend you do, because you have nothing to lose. If you sign up for Qualtrim today, you have a 30-day free trial to make sure you love it before paying a dime. After that, it's only $10 a month, cancel anytime. So try it out if you haven't. I think you'll love it. We're constantly improving it, constantly adding tools to it, and I believe it's by far the best value for what you're getting with stock analysis tools. So go ahead and try it out. I'll drop a link to it in the pinned comment below and let me know what you think. Now moving on, let's go ahead and jump into my portfolio and the upcoming earnings and the companies that have already reported earnings. I first want to do an accounting of how this portfolio has done so far this earnings season. We're around 70% of the way through. We've gotten through most of the big companies, but we still have a ways to go. So let me go through top to bottom and figure out how this portfolio has done. We'll start off with the financial category. In this, I have two companies, S&P Global and MasterCard. S&P Global's is very simple. They beat on their top line and bottom line. They grew their revenue by only 3%, but this company has such good control over their costs that even though they grew by only 3%, they only grew their expenses by 1%, so their margins actually improved. They actually became more profitable. And they also announced that they're increasing their buyback program by another $1 billion. So this company is a buyback machine. The next company that we have is MasterCard. This is another very large position that I purchased in this year. MasterCard's simple as well. They beat on the top line and the bottom line. Just like Visa, this company's an absolute monster. It's such an efficiently ran, wide moat company. So S&P Global and MasterCard's earnings are both great, and both of these companies have traded relatively flat for the past couple of years, so I've taken this opportunity to really add to these positions. Now next up we have Microsoft. This company's earnings were phenomenal. I did an entire video breaking them down in depth, so I won't do that here, but I'll just say the company really outperformed my expectations. They grew faster than expected. Most of the businesses of Microsoft are doing really well, and they grew their earnings per share by 10% year over year. So even in a difficult year like 2023, when a lot of companies are struggling to find growth, Microsoft continued to grow at double digits. And then finally, we get to the industrials. We have Canadian Pacific and Union Pacific. These are both new positions this year. And Canadian Pacific is the first company to technically miss their earnings expectation. Now here it has it, they missed their earnings expectation and it's highlighted in bright red, but notice how it's only by 2 pennies. Come on, they basically were in line. You can call that a miss, but a miss by 2 pennies when their expectation was 90 cents, that's not a big deal. They missed their revenue projections by 10 million out of a revenue base of 2.27 billion that quarter. So again, these are very minor misses. I would say that these are mostly in line. And then Union Pacific beat on their earnings per share in the revenue estimate, though they mentioned they benefited from a one-time real estate transaction. Those are the companies in my portfolio that have so far reported earnings. All of them have beat their earnings projections or at least came in line. And I think overall they're doing very well. So I'm really happy with the performance so far, but I can't celebrate just yet. We have a number of companies that have not reported earnings yet. In the restaurant category, neither Starbucks nor Texas Roadhouse have reported earnings. Now, Starbucks is a company that I bought into low and I sold it when it traded up to its all-time highs. So this is a company that I only own $4,000 of. It's important, but it's not the biggest holding. Then we have Texas Roadhouse. This one is a huge, meaningful position. It's now at $46,000 in value with a gain of over $12,400. This one has been a phenomenally good performing stock over the past year. I was buying this company in the 70s and now it's traded up to 112. So the company's gone through a massive run in stock price. And that's where it makes me slightly nervous when these companies do so well going into earnings. To give this some context here, Texas Roadhouse is trading at the highest price point it has in its entire history. So we zoom out the past 5 years, it's at all-time highs. And that is the same throughout the long-term history of the company. We're at all-time highs. Now, personally, I think the earnings are going to be good. I think that Texas Roadhouse is a very well-ran company. Now, it's trading at a 24 PE ratio, which I still think is decent value for this company. I believe it's marginally undervalued. Now, I do believe if the company does show any weakness in its earnings, in its free cash flow or its projections, it will drop because market participants will want to take their gains. They've made a lot of money over the past 6 months, and I think they'll want to do gain taking. If this company trades down because of any type of weakness in their earnings, I'm going to use that as an opportunity to deploy some of my cash. And I would love to add more to Texas Roadhouse if we see weakness in the stock price, but it would have to trade down a meaningful amount. So if it drops by 10%, I'm going to be buying a lot of this company. Viici's a company reporting earnings today. This is one that I'm not worried about. I don't pay too much attention to it. I think that Viici's going to be fine. They're collecting their rent, they're buying more real estate, and I believe that the properties in Vegas are going to climb in value a meaningful amount. So I'm not concerned about this company at all. And then finally, we get to Apple, the biggest company in the market that's reporting earnings this Thursday. And I want to go into why I'm a bit concerned about this upcoming earnings report. Now, diving into Apple's upcoming earnings this Thursday, I first want to look at what the technical analysts are saying about this stock. Now, I myself am an investor that looks at the fundamentals of companies, meaning I look at what I believe the free cash flows will be, the adjusted free cash flows, I look at the earnings, and I look at what I believe is going to happen fundamentally with a company and its moat over the next 5 years. And I make large investments based off of those assumptions. But not everyone invests in the market that way. There's a giant segment of the market controlled by technicals, either meaning that there's day traders, swing traders, technical analysis, robo-investors, so on and so forth, that buy and sell these stocks and they move the price of companies, even ones as large as Apple, especially on earnings after hours. So I want to take a look at what Carter Worth has to say about this. He's one of the technical analysts that looks at how this company may trade.
We shall see. Of course, my bias is that it's priced in a whole bunch. We have a well-defined series of lower highs since its peak. And we know, of course, it peaked the same day the market did. It set the high for January 2021. And the issue is interesting. The implied move in earnings would take you right back to the August high from last summer.
So he's saying the company's priced in a whole lot, and we can look at those assumptions here. We can see that right now, Apple trades at a 25.4 forward PE and a 3.62 free cash flow yield. Now, when I look at his claim that it's priced in a whole lot, I think a lot of that is accurate. Apple is at a more full valuation than it historically has been at. The company historically has traded at valuations of 17 forward PE to 20, and now it's trading at a 25. And the free cash flow yield of Apple, this historically has been as high as 5, 6, even 7%, and now it's at a 3.62. Now, why is the company pricing in more? In my opinion, it's simple. Investors are catching on more and more every single year to the secrets of Apple, to how strong this company is. 5 years ago, There's only a couple people that really fully understood how powerful the moat was of Apple. There was Buffett. Buffett was one of the few that did a major bet on Apple, putting $30 billion into the company. He was the only one that really bet that heavily on it. He really understood that this company had a wide moat. But that was much lesser understood 5 years ago, and the valuation reflected that. When Buffett was buying Apple, it was around a 17 forward PE. So the company was cheap. And Buffett understood the company was cheap. Now again, this is obvious in hindsight, but 5 years ago, this wasn't so obvious. The market was giving this company a 17 forward PE. When I was buying Apple back in 2019, I had people arguing in the comments that 17 forward PE was too expensive for the company because it had previously traded at a 15. I really had comments saying that. But now we fast forward a couple years and it's traded up to a 25. Every subsequent year, investors realize the moat of Apple a little bit more. In fact, just last year, Morningstar upgraded Apple from a narrow moat to a wide moat. That's how recent the understanding of the market has been. Only last year, Apple had a wide moat. And I think this really gets to the bottom of it. I've been beating this drum for a long time. I've showed this chart before. If we break down Apple's revenue by segment and we cross out everything but the services revenue, you can see the growth rate of the services isolated, going from 10 billion per quarter in 2018 to 20 billion in 2022, doubling in revenue in only 4 years. That is an incredible rate of growth of a very high margin stream of revenue. As Apple sells more iPhones and iPads and watches and AirPods and Macs, every one of those lead to more lock-in to their ecosystem. And then they pull the levers of monetization. The levers of monetization are their service revenue. This is an incredible business model. So it is true that Apple is pricing in a better future now than it was 5 years ago. And this is reflecting the better understanding the market in general has over Apple's wide moat and how they lock users in and monetize them. The more the market overall understands the nature of Apple's business, the more it's going to appreciate how good it is and the higher the multiple is going to be. So in terms of that first concern that Carter has, I actually agree with him. I think that it is pricing in a lot more than it was a couple years ago, and that does leave more room for error. If Apple screws up anything to ruin that bright future, it'll cause investors concern. And here's where he goes into the implied movements of Apple stock after earnings.
Interesting, the implied move in earnings would take you right back to the August high from last summer. So we closed around 168.70. That high is 176. 3.9% would get you to that high. Either way, I think you would be right to hedge going into earnings. And in the event that it pulls a pop, like a Microsoft or something like that, I would sell into the pop.
So he says to be careful with this one. There's a lot priced in, and if it has a pop after hours, to sell it into the pop. Take your gains and run. So there you have the technical analysis thought on it. Apple's a tough one. Sell into any type of stock gain. On a fundamental basis, the company already has a lot priced in at a 25 forward PE. And then we have the sentiment around the stock. Overwhelmingly, the sentiment going into this earnings seems to be negative. In fact, look at some of the recent articles on Seeking Alpha about Apple. I've never seen a company like Apple have so much negative sentiment. So many people saying to sell it now. So with a lot of that negative sentiment, investors could be antsy about this stock and looking for opportunities to sell. Another thing that I'm a little bit concerned about with Apple is Microsoft's earnings. Now, Microsoft's earnings in general, like I said, were great. They were above my own expectations. They grew their earnings per share and almost every segment of their business is growing. Microsoft is at a point where it's as strong as it can get. But there is something that was a red flag about Microsoft's earnings. Let me bring up Microsoft's recent earnings report right here, and I'll scroll down to the relevant portion. What we have here is a segmentation breakdown of all of Microsoft's various businesses. Like I said, when you go through these, most of them are growing. 25%, 17%, 18%, 4%. Overall, the company's growing. But there's a couple parts of the company that are shrinking. Now, Windows OEM represents the hardware sales of Windows devices. This is down 28%. That's a massive decline. Then we have devices. This segment of Microsoft is down 26%. So any part of the business that's hardware, that's not services, is down big. Now, this is fine for Microsoft because a huge majority of their business is software. But with Apple, still the huge majority of their business is hardware. So even though they're growing their services steadily, I believe if they have worse than expected numbers with hardware, that we could see a sizable drop in stock price. And based on Microsoft's earnings, I believe there is a chance of that. So to summarize, we're going going into Apple's earnings with the stock up 35% year to date, which is way outperforming the market this year. We have a PE ratio of 25, which is higher than its historical average. We have technical analysis saying to sell the stock, fundamental analysis on Seeking Alpha saying to sell it, and we have Microsoft, their devices business is going down. So there's a lot of different things to be concerned about with this earnings report. I've been through a lot of Apple's earnings, and even though a lot of investors get caught up in the immediate numbers, I know the long-term plan of Apple, and I think they're executing incredibly well. I think this company is still fully on track to grow meaningful profits in the future. So even if we have some weakness this year, which I believe we could, I'll be using that as an opportunity to buy the dip, not an opportunity to sell out of the position. Now moving on, we have some big news that JP Morgan has officially seized control of First Republic Bank. So we have another domino to fall. First Republic Bank, which unfortunately a number of dip buyers bought into this stock, it's now completely gone under. It was taken control of by the FDIC and subsequently sold to JP Morgan. Now these deals are pretty complex. They say JP Morgan said it will assume all of First Republic's $92 billion in deposit, insurance, and uninsured. It is also buying most of the bank's assets, including about $173 billion in loans and $30 billion in securities. So they're taking on everything from First Republic Bank. As part of the agreement, though, the Federal Deposit Insurance Corp, that's FDIC, will share losses with JP Morgan on First Republic's loans. The agency estimated that its insurance fund would take a hit of $13 billion in the deal. JP Morgan also said it would receive around $50 billion in financing from the FDIC. And after this, Jamie Dimon had said that we're on the tail end of this crisis. We're basically getting through it. Things are getting sorted out. He doesn't think it's going to be a systemic problem anymore. This seems to be something that's wrapped up, and that's the way that I felt about this for a long period of time. First Republic was a big bank. Any bank that has over $100 billion in assets is a big bank. But as soon as the government comes out and says that FDIC will backstop every single depositor, right when that happens, I think the systemic issues are gone. I think they're over. There's going to be more changes in the banking system. Jamie Dimon says there's going to be more consolidation. There's going to be more struggles for regional banks. But overall, I agree. I think that this banking crisis has mostly come to an end. Now, as you may expect, as one crisis is coming to an end, another one is brewing. There's always a crisis around the corner. This time it's with commercial real estate property. We've been hearing rumors of this, lots of predictions. Even Elon Musk talked about how bad the commercial real estate industry is. And now we have Charlie Munger saying that the banks have given out a lot of bad loans to commercial real estate. He says it's not nearly as bad as it was in 2008, but trouble happens to the banking just like trouble happens everywhere else. In the good times, you get into bad habits. When the bad times come, they lose too much. Now, this is a problem that happens everywhere in business, but I would also say that this is uniquely worse with anything using a lot of leverage and a lot of debt. Debt is where you see tons of destruction happen in the equity markets. Anytime you go through history, there's two different categories of ultimate destruction with companies. One of them is debt, one of them is fraud. Those are the two different categories. It's always debt or fraud. And in the real estate category, there's a lot of debt used. A lot of real estate investors like to leverage up as much as possible. That works out when interest rates are low, but when interest rates rapidly rise, that can lead to trouble. Quote, Berkshire has made some bank investments that worked out very well for us. We've had some disappointments in banks too. It's not that damned easy to run a bank intelligently. There are a lot of temptations to do the wrong thing. When investors get used to using a lot of leverage and margin to bump their returns, it's the same thing with banks. Banks can make very poor investments with a lot of leverage, and that doesn't pay off in the long run if those loans collapse at the same time. We've seen that happen with a number of banks already. Now it could happen with the real estate loans. Quote, we have a lot of troubled office buildings, a lot of troubled shopping centers, and a lot of troubled other properties. There's a lot of agony out there. Now, whether or not this turns into a big crisis or not in the real estate category is debatable. Everybody has their projections and thoughts. Ultimately, nobody really knows the full extent of what's going to happen. But there's two ways to protect yourself from this problem. One of them is to not own banks. And that's what I've done. I do not own banks anymore. I believe that they're just too difficult to fully understand the risk that they take. They're so complex. They have so much leverage, way more leverage than a normal company. So when I look at banks, I decided to exit that category entirely and focus on different companies that I believe I understand to a greater extent. The next thing that you can do is simply avoid companies that have a lot of debt. In almost my entire portfolio, I avoid companies that have excessive amounts of debt. Most of my companies have relatively no debt. There's only one that uses a lot of debt, and that is Vici Properties, which is a REIT, a real estate investment trust. This is the only one, and I've invested in this company because I believe that they're going to be able to weather through this storm. Like the rest of these companies that rely on taking out more debt, Vici does as well. Their average duration of their loan is around 7 years. So we have some time until Vici has to take out more debt. But once they do, the cost of their capital could be increased during that time period. And if that happens, their earnings will go down. So this can impact Vici like other companies. But in my opinion, it's not quite as exposed as other real estate companies. The tenants that Vici has are not your typical real estate tenants. They're Fortune 500 companies, and they can't move out of their locations. They're in very long contracts. So while I keep an eye on this company, I'm not as concerned about it as other real estate investment trusts out there, and I think this one's a little bit more insulated. Now that's going to be it for this episode. If you want more content, check out the Patreon. There's a link in the description of this video, and that gives you access to Qualtrim as well. So you get both of them included. And again, there's a free trial for the entire month, so I'd recommend trying that out if you haven't. That's all for now. I'll see you in the next one.